For weeks, something has felt off in the silver market. Prices move, but the physical supply seems to get tighter. The charts look calm, but the inventory in vaults is shrinking. Paper contracts trade millions of ounces, while real, physical metal quietly disappears from the market. Tonight, at the London Open, we might finally get a glimpse of what the real silver price actually is. Because what's about to happen isn't just another trading session. Think of it as a pressure test for the entire global market. Right now, a major battle is heating up between the East and the West over silver. There's a growing divide between the paper silver markets in London and New York, and the intense physical demand coming out of Asia. For a while now, premiums in Shanghai have been flashing warning signals. Buyers in Asia are consistently paying more for physical metal than what the Western futures markets are pricing it at. That gap is incredibly important. When physical demand constantly outpaces the paper price, something eventually has to break. There are only two ways this can resolve. Either the premium collapses, meaning Asian demand suddenly evaporates, or the global reference price has to readjust higher to meet the physical reality. There is no third option forever, and the London Open sits right in the middle of all this tension. Now, why does London matter so much more than you might think? Many retail investors focus on the COMEX exchange in New York. But London? London is the heart of the global over-the-counter precious metals market. The LBMA system there clears enormous volumes of metal every single day, often far exceeding what you see on futures exchanges in notional terms. If liquidity starts to tighten in London, that's when the real stress begins to show. We'd see lease rates spike, spot premiums widen, and delays in physical settlement would increase. And stress in the precious metals markets never stays quiet for long. It spreads. This brings us to the core of the issue, the paper versus physical divide. Here's what sophisticated traders are watching like a hawk tonight. First, silver lease rates. If these rates climb sharply, it suggests that physical metal is becoming much harder to borrow. It's a subtle but incredibly powerful signal that supply is tight. Second, they're watching the spread between the spot price and the futures price. If spot silver starts trading at a noticeable premium over futures contracts, it's a clear indicator of immediate, urgent demand for physical metal right now. And third, vault movement data. We've seen it happen before where large withdrawals from London vaults occur right before a major price spike. When that much metal moves, you can bet it's moving for a reason. So why does this time feel different? In past years, a lot of silver's volatility was driven purely by speculation. But this time, the macroeconomic conditions are fundamentally different. We're seeing persistent global inflation that just won't go away. Central banks are quietly accumulating hard assets like gold. And industrial demand for silver, particularly from solar and AI infrastructure, is growing at an incredible pace. On top of all that, there's an increasing distrust in fiat currency systems around the world. Silver is no longer just a precious metal. It's becoming a strategic asset, and that shift changes the entire psychology of its pricing. Let's talk more about that industrial demand because it is not slowing down. The green energy transition alone is completely rewriting the projections for silver demand. Every solar panel requires a significant amount of silver. EV infrastructure adds even more pressure. High-performance electronics and everything from our phones to data centers continue to expand. Unlike gold, which is primarily a monetary asset, silver has massive industrial consumption. This creates a unique dual demand structure: investment demand plus industrial demand. When both of those drivers align and push in the same direction, supply can tighten extremely quickly. And the supply isn't growing dramatically to meet it. Mining output has been relatively flat compared to the projected demand increases. That's a structural imbalance, building quietly right beneath the surface level price action. Now let's get into the psychology behind tonight's session. Markets are really just emotional machines wrapped in mathematical systems. Right now, sentiment around silver is cautious. Many traders remember past fake breakouts and got burned. Others are fearful of the sudden volatility that silver is known for. But here's the thing. When positioning becomes this defensive, it doesn't take much to trigger a massive momentum shift. If London opens strong tonight and holds on to those gains throughout the session, it signals that there is institutional support. If any weakness or dips get aggressively bought up, that's even more telling. Because real accumulation, the smart money buying, happens on the dips, not during the hype rallies you see on the news. So what could actually trigger a major price shift? Several catalysts are all aligned right now. It could be unexpected macroeconomic data, a sudden weakness in the dollar, or new geopolitical tensions. It could be headlines about a physical supply shortage, or even just commentary from a central bank. But often the big move begins quietly, not with a big news flash, but with the flow of money. Large orders, persistent buying, subtle but constant pressure. By the time the mainstream media reacts and puts it on the front page, the move is already well underway. From a technical perspective, a break above key levels changes everything. Silver is currently sitting near some psychologically important price zones. If the liquidity in London drives the price above those resistance levels, and then New York confirms that move later in its session, that's when the momentum algorithms will activate. And once the algorithms pile in, volatility accelerates fast. Short sellers will be forced to rush in and cover their positions. Momentum funds will enter to ride the wave. And then retail traders will follow. That is how small breakouts can turn into powerful, sustained runs. But we have to be clear, there's also risk involved. Let's be honest, silver is historically volatile. Sharp rallies are often followed by equally sharp pullbacks. If London opens weak tonight and fails to attract those physical bids, it could easily trigger short-term downside. This is especially true if the US dollar strengthens, bond yields rise, or we see a broad sell-off in risk assets. That's why tonight matters so much. It's not just about the direction of the price, it's about conviction. This is why smart investors are watching behavior, not headlines. Instead of reacting emotionally to the price ticker, experienced traders are monitoring the order flow, looking for volume spikes, and analyzing the spread behavior. They're also watching cross-market correlations. For example, if silver rises while the dollar holds steady or even strengthens, that's a sign of real power. If silver rises despite higher bond yields, that's an even stronger signal. Strength during adversity points to real underlying demand that can't be ignored. Looking at the bigger picture, some analysts believe we're witnessing the early stages of a broad repricing cycle across all commodities. We've seen it in energy, in copper, in uranium, and now, potentially, in silver. If that thesis holds true, then silver may not just be trading on technical signals. It may be repricing structurally for a new reality. And a structural repricing doesn't just end in a single trading session. It unfolds over months and sometimes even years. So what happens if London actually exposes the real price tonight? If physical demand finally overwhelms the paper pricing, the futures markets will have no choice but to adjust. Arbitrage traders will close the pricing gaps and the premiums will compress upward, pulling the global price with them. That's when you'll start seeing the headlines saying, "Silver surges unexpectedly." But for those of us watching the London Open tonight, it won't be unexpected at all. It will be confirmation of what the underlying data has been telling us all along. The London Open isn't magic, but it is a very sensitive pressure gauge. And right now, the silver market feels extremely pressurized. Whether tonight brings a breakout, a fake move, or just quiet accumulation, one thing is clear. The real story is not going to be on mainstream financial news. It's hidden in the spreads, the vault flows, and the premiums. Smart investors aren't watching the noise, they're watching the signals. And tonight, those signals could speak louder than they have in a very long time. Have you ever felt like you're watching a movie and you know the big twist is coming, but you just don't know when? That's exactly what's happening in the silver market right now. And last night, London just handed us a major clue. Forget the complicated charts, forget the confusing jargon you hear on financial news. We're going to talk about something much more real, much more powerful: market behavior. Last night, the London market opened and something unusual happened. Silver had every reason to dip. The dollar was flexing its muscles. Market sentiment was a bit shaky, but silver didn't just hold its ground, it fought back. Every little dip, every small price drop was almost instantly bought up. Think about that. It's like trying to push a beach ball underwater. The harder you push, the more aggressively it wants to pop back up. This wasn't just a random fluctuation, it was a signal, a quiet message from one of the world's biggest financial centers. The message was clear: there are powerful buyers out there hungry for physical silver, and they are not waiting around. Now, why is this so important? Because the game isn't over. London just played its hand, and now all eyes are on the US market, on New York. London exposed the tension simmering beneath the surface, but New York's reaction will either confirm it or try to suppress it. If the silver price continues to hold strong, or even starts to climb as the US market gets going, it's a massive confirmation. It tells us what many insiders have suspected for months. The demand for real, physical silver is far stronger than the paper markets are letting on. The paper market might show one price, but the people who actually need the metal are willing to pay more. But what if the price falls in New York? Does that mean London was wrong? Not at all. A price drop in the face of such strong underlying demand doesn't make the pressure disappear. It just builds it up, coiling the spring even tighter. It's like putting a lid on a pot of boiling water. You can hold it down for a while, but eventually that pressure has to go somewhere. So either way, whether the price goes up or down today, the tension is undeniable. Something big is brewing, and we're getting closer to the moment it boils over. So how can you see this for yourself without getting lost in complex financial analysis? You don't need a PhD in economics. You just need to watch for 3 simple, subtle signals. First, watch the price dips. Are they sharp and scary, or are they shallow and quickly erased? When dips get bought up fast, like we saw in London, that's a sign of incredible strength. It means buyers see any price drop not as a reason to panic, but as a discount, a buying opportunity. Second, keep an eye on what are called spot premiums. Don't let the term scare you. It simply means the extra amount people are willing to pay to get their hands on physical silver right now, today, instead of waiting for a future delivery. When these premiums are high, it's the market screaming that immediate supply is tight. It's the difference between ordering a pizza for delivery in 30 minutes versus being told you have to wait 3 hours. If you're hungry now, you'll pay extra for the faster service. In the silver market, high premiums mean industries and investors are hungry now. And the third signal, perhaps the most telling, is vault withdrawals. This is the real world movement of the metal. Every week, major exchanges report how much physical silver is leaving their secure storage facilities, their vaults. When you see a consistent trend of silver leaving the vaults, it's not going for a walk. It's going to factories, to mints, to investors who want it in their possession. It's a quiet but powerful hint that the available ready-to-sell inventory is shrinking. These three signals, quick dip buying, strong premiums, and vault withdrawals, tell a story that no news headline can. They tell the story of real-world scarcity. And let's not forget the massive, unstoppable force driving this, industrial demand. Silver isn't just a pretty metal for coins and jewelry. It's a critical component in our modern world. Your smartphone has silver in it. The electric vehicle you're seeing everywhere needs silver. And most importantly, the green energy revolution runs on silver. Every single solar panel being installed on a roof or in a massive solar farm requires a significant amount of silver to function. This isn't speculative demand. This is essential, non-negotiable demand from the world's biggest industries. When these companies, from tech giants to automakers to energy firms, start to worry about securing their future supply, they don't just send an email. They start buying quietly at first, trying not to disrupt the market. But as more and more of them scramble for a finite supply, the effect snowballs. The quiet buying becomes aggressive buying, and that's when you see the dramatic price moves. This is why the current situation isn't just another blip on a chart. It feels different. It feels like a fundamental structural shift in the entire market dynamic. Now, I know what some of you might be thinking. But wait, the US dollar is strong right now. Shouldn't that push the price of silver down? And normally, you'd be 100% correct. Traditionally, a strong dollar makes commodities priced in dollars like silver more expensive for foreign buyers, which usually dampens demand and lowers the price. But look at what's been happening lately. Silver has been defying this rule. It's been holding its own, and in some cases, even rising, while the dollar strengthens. What does that tell you? It tells you that a more powerful force is at play. The overwhelming pressure from physical demand and the growing reality of scarcity are starting to overpower the traditional market mechanics. The rulebook is being rewritten right before our eyes. This means that the moves we're seeing tonight and in the coming days are not just about currency fluctuations or trader algorithms. They're about a real-world tug-of-war between a limited supply of a critical metal and a relentlessly growing demand for it. So, what could happen next? Let's break down the possibilities. Scenario 1, the price holds strong, building on the momentum from London. This would be a huge confidence booster for the market. It would signal that the bulls are firmly in control and could attract a new wave of investment, creating a self-reinforcing upward cycle. Scenario 2, we see small pullbacks. The price might dip a little as the New York session gets underway. But if these dips are shallow and quickly bought up, they could actually be bull traps designed to shake out weak hands before the next leg up. Smart money often uses these moments to add to their positions at a better price. And then there's scenario 3, the breakout. If the market digests the signal from London and reacts aggressively, we could see a very sharp, very fast jump in price. This is what happens when that coiled spring is finally released. The pressure that's been building for months could unleash in a matter of days or even hours. And even if the price does dip significantly today, you have to remember the underlying scarcity, the industrial demand, none of that goes away. A lower price today might just mean a more explosive move tomorrow. This is why this period is so different from what we've seen before. Most people on Wall Street watch headlines and quarterly reports. They're looking in the rearview mirror. But smart investors, the ones who get ahead of the curve, watch behavior. They ask the important questions. Who is buying? How desperately are they buying? And what price are they willing to pay to get what they need right now? The answers to these questions reveal the true state of the market, long before it becomes front-page news. When the signals from London, a hub of physical trading, align with the signals from New York, the center of paper trading, that's when the true price of silver is revealed. That's the moment of truth. And based on what we're seeing, we are closer to that moment now than we have been in a very long time. So let's wrap this up. The key takeaway is simple. London sent a clear, powerful signal that the physical market is incredibly tight. New York is on the clock, and its response will be critical. Underneath it all, industrial demand is not just growing. It's piling up, creating immense pressure. And for anyone who is paying attention, the events of today and the coming week could mark the beginning of a truly major historic move in the silver market. So keep your eyes open. Watch the behavior, not just the price ticker. Because right now, the signals are speaking much, much louder than the headlines. All right, welcome to part 3 of our silver saga. The showdown between London and New York is over for now. And the big question everyone's asking is, will silver finally break out, or will the market push it back down? After months of quiet accumulation, rising premiums, and growing industrial demand, the system is right on the edge of a tipping point. This is the moment of truth. As silver reacts to today's COMEX session, all the signals are converging. Physical premiums are still high. Vault withdrawals are continuing. And the spot price is fighting back against paper pressure. Folks, these aren't just coincidences. This is a market screaming that real scarcity is here. And scarcity always triggers a reaction, usually a fast one. So how does a silver breakout actually happen in today's market? It typically unfolds in a few stages. First, you get that early momentum. The initial price gains are quiet. A couple of large orders push the price above short-term resistance. Then, the algorithms kick in and momentum starts to build. Short positions start covering. Volume spikes, but at this point, most retail traders haven't even noticed. Next comes the confirmation. If the price manages to hold above these key levels for the first couple of hours of COMEX trading, confidence surges. This is when institutional buyers start piling in. Retail participants begin to notice. You'll see chatter picking up on social media, but the mainstream headlines are still skeptical. This is the perfect storm for a rapid move upward. Then you get acceleration. Once momentum starts feeding on itself, the price can go vertical. This is especially true if short sellers are forced to cover their positions. This is where silver has historically surprised everyone. The huge spikes we saw in 2010, 2011, and even 2020 all followed this exact pattern. So what are the key levels to watch today? Technically, silver has several make or break points. The first is that $27.50 to $28 range. That's the first psychological barrier. Breaking it signals real momentum. Then you have the $29 to $30 zone. This is where retail attention just explodes. The media starts asking, hey, why is silver surging? And if we get above $32, that's potential short squeeze territory. This is where positions that have been betting against physical pressure start to collapse. If London's strength holds and COMEX validates it, we could see an accelerated price move above these levels. But here's the subtle yet critical factor, the role of physical supply. Even if paper markets try to suppress the price, physical demand always wins in the medium term. Buyers in Asia are still paying premiums. ETF inflows remain strong, and industrial supply contracts are getting tighter. When paper markets ignore the physical flows, they can't ignore them forever. Eventually, the price has to reflect reality. So, what could trigger this explosive phase? A few catalysts could ignite a breakout within hours. Any sudden dip in the dollar boosts silver. Geopolitical tensions are always a driver for safe haven metals. Unexpected macro data, like inflation reports or Fed commentary, can act as a trigger. And large physical withdrawals from vaults are a quiet but very loud market signal. The key is that these triggers don't create the move. They just amplify the momentum that's already building. And why could this rally surprise so many people? It's because most retail traders are reactive. They wait for the headlines. They wait for the momentum to be obvious. They wait for confirmation. But the smart money acts quietly, positioning themselves long before the crowd even notices. That's why, if this breakout happens, it might feel sudden and shocking to the average investor. But for those watching the signals closely, they have a front row seat to the start of a major structural repricing. Just look at historical context. Think about 1980 or the 2010-2011 silver rallies. The moves started quietly. Physical scarcity was the underlying driver, and momentum accelerated sharply once mainstream traders finally jumped in. History shows us that silver doesn't need hype to explode. It just needs the right combination of pressure, scarcity, and momentum alignment. And right now, all three of those factors are in play at the same time. So what are the professional traders watching? They're monitoring the spread between spot and futures prices. They're watching London Vault withdrawals. They're looking at COMEX, open interest, and retail positioning. Each of these indicators is like a gauge measuring the tension in the market. When they all align, the probability of a breakout spikes. Retail traders often miss these subtle cues, which is why those initial gains can be so surprising. Of course, no rally is without risk. Sudden profit taking could temporarily pull prices down. Market makers might try to suppress the moves, and a macro shock could reverse the momentum. But even if we see short-term dips, the structural imbalances are still there. This isn't just a typical swing trade. This is a full-blown repricing event. So what could happen in the first 24 hours if a breakout is triggered? You'd likely see a strong morning rally with the price jumping past early resistance. Then you'd get acceleration from short covering as leveraged positions are forced to close. After that, the retail frenzy begins. Social media chatter draws in the masses. And finally, you'll see premiums widen as physical markets start demanding more for immediate delivery. Once physical premiums widen while the paper markets are surging, that momentum often continues for several sessions. Looking at the bigger picture, beyond just today, silver is at a structural turning point. Industrial demand is only going to keep growing. Above-ground inventory remains tight. And global macro uncertainty is keeping hedging demand high. The market is shifting from a technical trading phase to a structural repricing phase. That's the difference between short-term swings and a sustained long-term upward trend. So, what's the actionable insight here for traders and investors? Watch the London and COMEX spreads in real time. Track those vault withdrawals and ETF flows. Use those technical levels we talked about, $27.50, $29, $32, as your reference points. And remember, physical scarcity is what drives the price in the medium term. Positioning matters, timing matters, and awareness matters most of all. So here's the final takeaway. The silver market is no longer a calm, predictable arena. London exposed the pressure, COMEX is now answering, and physical demand is silently dictating the rules of the game. A breakout tonight isn't just possible. It's probable if these conditions hold. For those who are watching carefully, the signals are louder than the headlines. The quiet accumulation matters more than the hype. And in the end, scarcity always wins. Silver may be about to surprise the market, and when it does, it could completely reshape how we perceive this metal. For now, the only certainty is tension. The rest depends on how the market decides to release it. Thanks for watching, and be sure to subscribe for more updates.